Have you ever wondered if you could potentially supercharge your investment strategy by leveraging the margin capabilities of M1 Finance and then somehow combining them with the offerings of other brokers? It's a fascinating thought, isn't it? The idea of optimizing your capital efficiency, perhaps accessing different investment vehicles, or even just exploring ways to get the best of all worlds. Today, we're going to dive deep into this very question. Can you truly merge or effectively utilize M1 Finance's margin capabilities in conjunction with other brokerage accounts? This isn't just a theoretical exercise. In the world of investing, every edge counts. And for many, margin offers that edge, the ability to amplify returns, though it comes with amplified risk. M1 Finance has gained significant popularity for its unique pie investing approach, automated rebalancing, and competitive margin rates. On the other hand, traditional brokers offer a wider array of investment products, advanced trading tools, and often, more specialized services. The allure of combining the strengths of both is undeniable. But let's pump the brakes for a moment. Before we get too far ahead of ourselves, it's crucial to understand what margin actually is, particularly in the context of M1 Finance, and how it fundamentally operates across different brokerage platforms. Understanding margin, the basics. At its core, margin investing involves borrowing money from your broker to buy securities. You put up a portion of the investment's cost, known as the initial margin, and the broker lends you the rest. The securities you purchase then act as collateral for the loan. This can significantly increase your purchasing power, allowing you to control a larger position with a smaller amount of your own capital. The upside, when your investments perform well, is that your percentage returns on your own capital are amplified. If you invest $1,000 and borrow another $1,000 on margin to buy $2,000 worth of stock, and that stock goes up 10%, you've made $200. On your initial $1,000, that's a 20% return, excluding interest and fees. Without margin, your 10% gain would only be $100. However, the downside is equally amplified. If the stock goes down 10%, you've lost $200. Plus, you still owe the interest on the borrowed money. And here's where it gets really important. If the value of your collateral falls below a certain point, your broker can issue a margin call, requiring you to deposit more funds or sell off assets to bring your account back into compliance. Fail to meet a margin call, and the broker can liquidate your positions without your consent, potentially at a significant loss. M1 Finance and its unique margin offering. M1 Finance offers what they call M1 Borrow, which is their version of a margin loan. What makes M1 Borrow particularly attractive to many investors are its relatively low interest rates, especially for M1 Plus subscribers. It's designed to be simple and straightforward, allowing eligible investors to borrow up to 35% of their invested portfolio value with no credit checks or loan applications in the traditional sense. The interest is charged daily and calculated on the outstanding balance. The repayment is flexible, you can pay it back on your own schedule, and there are no fixed payment dates. This flexibility and competitive pricing are key reasons why investors are drawn to M1's margin capabilities. M1 Borrow is directly tied to the value of your M1 Finance investment portfolio. The amount you can borrow and the ongoing maintenance of that loan are contingent on the value and composition of the securities held within your M1 account. This is a crucial distinction we'll come back to. How traditional brokers handle margin. In contrast, traditional brokers like Charles Schwab, Fidelity, Interactive Brokers, or TD Ameritrade, now Schwab, also offer margin accounts, but their terms, rates, and functionalities can differ significantly from M1. Interest rates. While some traditional brokers offer competitive rates, M1's M1 Plus rates often stand out, particularly for smaller loan amounts. For larger amounts, some institutional brokers might offer comparable or even better rates, but this usually requires substantial assets. Collateral requirements. Similar to M1, traditional brokers use the securities in your account as collateral. However, the specific maintenance margin requirements, the percentage of equity you must maintain in your account, can vary. Eligible securities, the types of securities that qualify for margin and their loan value, how much you can borrow against them, can also differ. Highly volatile or thinly traded securities might have lower loan values or even be ineligible for margin. Trading tools and features. Traditional brokers typically offer a much broader suite of trading tools, research, and investment products, including options, futures, and a wider range of individual stocks and ETFs that might not be available on M1. The million-dollar question: can you merge M1 Finance margin with other brokers? Now, let's get to the heart of the matter. The short, direct answer is no, not in the way you might be imagining a direct merge or transfer of margin capabilities. Here's why this is a fundamental limitation. Margin loans are broker-specific. A margin loan from M1 Finance, M1 Borrow, is a loan from M1 Finance. The collateral for that loan is the portfolio held at M1 Finance. Similarly, a margin loan from Fidelity is secured by assets held at Fidelity. You cannot take a margin loan from M1 Finance and then use those borrowed funds directly within a Fidelity account to buy more securities and have Fidelity recognize your M1 portfolio as collateral. The two systems are entirely separate. Collateral is held by the lending broker. The core principle of a margin loan is that the lending institution holds the collateral. They need to be able to liquidate those assets if you fail to meet your obligations. M1 Finance has no control or visibility over the assets you hold at another broker, and vice versa. Regulatory frameworks. Margin lending is a highly regulated activity. Brokers must adhere to strict rules set by FINRA, Financial Industry Regulatory Authority, and the Federal Reserve, Regulation T, which dictate initial and maintenance margin requirements. These regulations apply to the specific broker providing the loan and the assets held under their purview. So, what are the practical implications and alternatives? While a direct merger of margin capabilities isn't possible, understanding this limitation opens up avenues for strategic thinking about how you can utilize M1 Finance's margin in conjunction with other brokerage accounts, albeit indirectly. Scenario 1. Using M1 Borrow for external investments, indirectly. You can take out a loan from M1 Borrow and then transfer those borrowed funds to your bank account. From your bank account, you are then free to transfer those funds to another brokerage account, e.g., Fidelity, Schwab, Interactive Brokers, and use them to purchase securities there. With that said, thanks for watching, and until next time.